You don't put that much emphasis on macro. You've said we can control the sails, but not the wind.
Correct.
Explain.
Well, I think it's a lot of fun to talk about the global economy or the U.S. economy or politics or taxes and all the rest. But so many of those things are beyond one's control. And so we think it's a lot better to focus on the things that one can control and adapt to the things one can't control.
That's been a short-term factor. We could get into a long debate. What are the long-term consequences of QE, QE2, expanding balance sheets? That's a very complicated issue that all the people who were convinced that it was a disaster to do QE 10 years ago are still trying to figure out when that's going to be a disaster. So all we do is we don't think about the market, we think about our companies.
But my question really is, a lot of the things that you're invested in are economically sensitive, right? You're talking about the airlines, you're talking about Amazon, and that's a retail play, among other plays. Does that change if, in fact, the economy does take a downturn? What if we do say a recession? Does that dictate how you're going to invest?
Well, not really, because we're not really looking to say we believe the economy is going to grow or not going to grow, and so we're not reasoning from the macro to the micro.
Yeah, hi. My question relates to on the macro environment. You're seeing increasingly manufacturing moving broad, and companies increasingly focus on their service component. How does that work out in the value in terms of being able to invest in increasingly service-based companies in North America?
Well, I don't think that we really focus on macro. Basically, people who do Graham-related security analysis are interested in micro. And of course, if a company is in a business that's, let's say, manufacturing something and there's potential competition from abroad, you have to take that into account. For example, we own shares of a company called Hager, which makes men's pants. I happen to sit on the board of directors of that company. The stock sells at about 18 and a fraction and has a tangible book value in the low 20s. One of the things they did was, over time, they got rid of all of their factories in the U.S. and now source 100% of their products from abroad. I think maybe 15 or 20% come from factories they have in Mexico and the Dominican, but the rest come from Uzbekistan, Bangladesh, Indonesia, China, all different kinds of places. So sometimes there can be an opportunity when a company is in transition to, let's say, being from a domestic sourcer to being a sourcer from abroad. So it's an issue, and competition certainly from abroad is an issue. But our focus is micro, not macro. And, you know, every investment firm, every investment bank, every commercial bank has economists who will give you their macro opinions of things. And, you know, our view is if you take 20 of these guys' prognostications and 10 of them are right and 10 of them are wrong, why don't you flip a coin? What do you have to listen to all these brilliant words from some economist?
You once said to me that you spent all your time looking at companies, analyzing them as businesses, and you didn't spend a lot of time worrying about the economy. Do you have a view on the economy now?
Well, I look at the economy. I look historically at the economy. I don't look at the future. I mean, that's weather forecasting. I look at the economy backwards to see what's happening, and the economy looks very good to me right now. Now, here's a big point. Remember this one. It's futile to predict the economy, interest rates, and stock market. I mean, people keep trying to do this. I mean, this would be useful. I would love to know when we get a recession. I'd love to know when interest rates are going to go up or down. I'd love to know when the stock market's going up. That would be helpful. I would like to get next year's Wall Street Journal. Unfortunately, you don't get it. I remember in 1982, we had a lot of people in this room around for 82. We had 20% prime rate, 15% long governments, double-digit unemployment, double-digit inflation. I don't remember anybody telling me about that in 1980. I remember everybody telling me about that in 1981. But in 83, I remember they said, well, the economy's bounced back. We're in a recession in 85. In 85, they said we have a recession. 86, in 87, something happened in October 87. I forget what something happened in October 87. Celtics lost 7 in a row. Something bad in 87. They said for sure we'll have a recession in 88, and they said 89 for sure we'll have a recession. And then 90, we're supposed to have the so-called soft landing, which we never had. So I've always said if you spend 13 minutes a year on economics, you've wasted 10 minutes. And all you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know. Again, it'd be terrific to know what's going to happen in the economy, but I deal with facts. If inventories are going up, if copper prices are going down, if room occupancy is going the wrong way, if people are building too many hotels, I look at freight car loadings when I own railroad stocks. I deal with facts. I don't deal with people tell me something's going to happen in the future. You might as well call the psychic hotline for that stuff. I think you have a better average.
So let's start off and talk about the economy a little bit. And obviously, we've been on a good long run here.
A very long run.
And yet, does that surprise you? And what would be the signs that you would look for to see that things were winding down?
Well, I look at a lot of figures just in connection with our businesses. I like to get numbers. so I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses. And it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses, what those numbers tell me. They're interesting, but they're not guides to me. If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year. We care a lot about the price. We do not care about the next 12 months.
But are you surprised at how long this economy has been expanding?
I've been surprised by all kinds of things in the last 10 years about the economy. I mean, I don't think there was any economist I've ever read that talked about negative interest rates for long periods of time. I mean, if you go back and read Keynes or you read Samuelson, you read any of them, they do not get into a negative rate environment. I think now there's still 11 trillion that's of government debt around the world that's at a negative rate. So we've never seen it before, and we've never seen, at least the conventional wisdom on a sustained period of long and growing deficits while the economy is getting better, extremely low interest rates, and really very little inflation. So something different is happening, but something different happens all the time. So, and that's one reason economic predictions just don't enter into our decisions. Charlie Munger, my partner, and I, in 54 years now, we've never made a decision based on an economic prediction. We make business predictions about what individual businesses will do over time, and we compare that to what we have to pay for them. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic even if the price was right.
All right, so you don't pay much attention to the dismal scientists then, I guess.
Well, I pay none in the sense of as a guideline to doing anything. It's entertainment. I mean, it's like going to a variety show or something like that. But and I just don't know of any economist that actually has bought businesses successfully or done well in stocks. Paul Samuelson did. And you may know he was a big shareholder of Berkshire. but it's, they make guesses, and there's so many variables. I mean, in the hard sciences, you know that, if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables, and the truth is you've got to expect good times and bad times in business. And if you were to buy an auto dealership and you're, wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to be sure you got a good business. But you wouldn't say, I'm going to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort.
Fair enough. I mean, so where do you think these low super rates are going to go and negative rates? I mean, just
No.
what are the implications on?
Well, I would say that's the most important question
Right.
in the world, and I don't know the answer.
Um,
No, if we knew the answer, it wouldn't be the most important question.
Ooh, I like that.
Yeah.
I mean, I don't like that, but
no, but it's
right,
true.
Yeah. Well, so let me ask this way then: what has investing in equities changed given the interest rate environment? It makes equities look super
Yeah,
cheap.
no, it reduces the hurdle rate.
Right.
That's why they like to decrease it, is that it pushes asset values higher, because obviously, if you promised to pay me something at 3% a year, that would have been a terrible instrument for me to own, almost any time in history. But today, if you're good for it, it's fabulous.
Right. I mean, did negative rates scare you, Warren?
They puzzle me, but they don't scare me.
Okay. Let's switch over and talk about bond yields and interest rates, because that's a crazy subject right now.
It is a crazy subject.
And
it is really crazy.
Yeah. So what is your thinking on that?
I don't know. I have never been able to predict interest rates, and I've never tried. I don't. Charlie and I, we believe in trying to function on or to focus on what's knowable and important. Now, interest rates are important, but we don't think they're knowable. And there are some things that are, this gets back to, sounding, who was it, Don Rumsfeld or something?
Known knowns and unknown
yeah, and all
unknowns
that.
and unknown
And
unknowns.
the question is the box that says knowns and important, knowable and important, is there anything in that box? And can you tell what's in that box and what isn't in that box? And it's what I call knowing your circle of competence. And my circle of competence doesn't include the ability to predict interest rates a day from now or a year from now or 5 years from now. So I say, can I function without knowing that? It's the same way as predicting what business is going to do or the stock market is going to do. I can't do any of those things. But that doesn't mean that I can't do well investing over time.
So then, macro forecasting is not critical to investing. We do not make our decisions based on macro forecasts, as I explained to you. We all have opinions. Our official dictum is that it's okay to have an opinion, you just shouldn't act as if it's right. And I think this is very important. Mark Twain said, it's not what you don't know that gets you into trouble, it's what you know for certain that just ain't true. And so we try to avoid holding strongly to those macro opinions. And finally, we don't do a lot of market timing, which is very, very hard to do. We do long-term investing in assets that we think are underpriced. And one of the things he says is we have two classes of forecasters, the ones who don't know and the ones who don't know they don't know. Now, I don't believe in forecasts, macro forecasts. People who forecast interest rates, performance of economies, performance of stock markets. And I don't think that my efforts to be a superior investor and most other people's are aided by macro forecasts. So am I saying that the forecaster is never right? No, I'm not saying that. The forecasters are often right. Last year, GDP grew 2%. Many forecasters forecast that GDP will grow this year at 2%. That's called extrapolation. And usually in economics, extrapolation works. Usually the future looks like the recent past. So usually the people who forecast a continuation of the current are right. The only problem is they don't make any money. Because let's take the economy. Most people forecast 2-something for this year. A growth rate of 2-something is cooked into the prices of securities today. If the growth rate turns out to be 2-something, everybody who forecasted that will be right, but security prices will not change much because that 2-something growth was anticipated and discounted a year or two ago. So all those people who are right won't make any money. Our forecast, so that's a correct. So most forecasts, extrapolation works all the time. Forecasts that are extrapolations work all the time, but they don't make any money. Logically, am I saying that forecasts never make any money? No. The forecasts that make money are the forecasts of radical change. If everybody's predicting 2.4% growth for this year, and if I predict -2, and it turns out to be -2, or I predict 6 and it turns out to be 6, I'll make a lot of money. So forecasts which are not extrapolations, forecasts which are radically different from the recent past, are potentially very valuable if they're correct. Of course, they're not of any value if they're incorrect. And if they're incorrect, they'll cost you a lot of money. If everybody else thinks it's going to be 2.4 and you predict 6 and it turns out at 2.4, you're probably going to have taken the wrong investments and lost a lot of money. So deviant forecasts, which turn out to be right, are potentially very valuable, but it's very hard to make them. It's very hard to make them correctly. It's very hard to make them correctly consistently. And somebody at lunch mentioned an early memo I wrote called The Value of Forecasts. And in one of, there was the value of forecasts, and then there was value of forecasts 2, I think, right? And in one of those, I reviewed the recent history of the Wall Street Journal poll. Every 6 months, the Wall Street Journal publishes the results of a poll of economists. And on, GDP growth, CPI, value of a dollar, the price of oil, whatever it might be, a bunch of phenomena. They do it consistently. And they ask like 30 people consistently over time. And so it shows basically that most of the time, when people get it right, it's because they predicted extrapolation and nothing changed. Once in a while, something changes radically, and invariably somebody predicted it. But the problem is, if you look at that person's other forecasts over the years, you see that that person always made radical forecasts and never was right any other time. So of course, if you're getting your information from a forecaster, the fact that he was right once doesn't tell you anything. You wouldn't, the views of that forecaster would not be of any value to you unless he was right consistently. And nobody's right consistently in making deviant forecasts. So the bottom line for me is that forecasting is not valuable. And that's something that my experience has told me. So we don't know what's going to happen, and randomness will play a big role in what happens. And randomness is by definition unpredictable.
So you said that you do not predict, you did not make any macro forecasts, right? But actually the macros can affect companies in a lot of ways. Like, I mean, if you have interest rate like 30%, I mean, 99% of the companies will be gone or something like that, right? So how do you even make an investment?
Okay, so now I know I'm not coming back to Google anymore because the people are too intelligent. Because this is one of the great traps. I say that we don't invest on the basis of macro forecasts. But you have to have an economic framework in mind when you predict the fortunes of individual companies. What I would say is, what we try to do is it's one thing to say that oil is at 50 and we're going to invest in this company because it will do fine if oil's at 50, survive if it goes to 30, and thrive if it goes to 70. But it's another thing to say oil is 50, I think it's going to 110, I'm going to invest in this company, which is going to be great if it goes to 110, but bankrupt if it stays at 50. So the question is, how radical are your forecasts? And we try to anticipate a future that looks pretty much like the norm, and make allowance for the thing that things other than the norm can happen. And I can't really be much more concrete than that. It's all, all this, by the way, all this stuff is judgment. You know, there are no rules, there are no algorithms, there are no formulas that always work. None of this is any good unless the person making the decision has superior judgment. And, you know, the first chapter of the book says the most important thing is second-level thinking. Most people think on the first level. To be a superior investor, you must think on the second level. You have to think different from everybody else. But in being different, you have to be better. You know, so the first level thinker is naive. He says, this is a great company, let's buy the stock. The second level thinker says, it's a great company, but it's not as great as everybody thinks it is. We better sell the stock. That's the difference between being an average person and a person with superior insight. By the way, most people are not above average. First, let me say that in the economic world or in the business world, or certainly the investment world, sometimes we have an idea what we think will happen. We never know when. And the biggest problem you can have is by believing that you know when something is going to happen and acting strongly on that. One of the guys who works for me once wrote a memo to his clients, and he had to express a simple rule. If you name a price, don't name a date. If you name a date, don't name a price. But if you name a price and a date, you can be wrong. In the other two cases, you can never be wrong. You say, well, I think that stock is going to sell at 40 sometime. They can't prove you wrong, you know, et cetera. So we talk about a correction, but we should not be we should not have so much hubris as to think we know when it's going to happen. That's number one. Number two, back in the crisis of 07, 08, people got into the habit of asking me and others, they kept saying, what inning are we in? This became the big question in that cycle. What inning are we in? And that's the way people talk about that. Now, when they said it back in 08, what they meant is, how close are we to the end of the crisis, is what they were asking. More recently, they've been asking it, and what they mean is how close are we to the end of the bullish phase of the credit cycle? And I've been saying we're in the 8th inning for a little while. And I realized about a year ago that there's one problem with that locution, which is that this isn't baseball, and we don't know how long the game's going to go. In baseball, if I tell you we're in the 8th inning, that means you can start packing up. But in investing, the game could go 9 innings, 11, 14. There's no limit. Like I said to Justice about his question about 7 to 8 year cycles, there's no limit. First of all, let me try to convince Justice and everybody else in the room not to fixate on the regularity of cycles. I think cycles are one of the most important things in the world. And if you're going to live in the world, I think one of the most important things is to recognize cycles as they occur and where we stand in them and what that implies for the future. But I think it's really a big mistake for anybody to think of cycles as being regular. You know, I've just finished a book, thank you for the intro, on the subject of cycles. It'll be out in October, and it's about managing the market cycle. And, you know, the prevailing thread through the book is a quotation that's attributable to, believed to be attributable to Mark Twain, that history does not repeat, but it does rhyme. It doesn't repeat. And what that means is that the reasons for cycles, their violence, their amplitude, their duration, their speed, and their reasons are never the same from cycle to cycle, including their timing. And the people who impute too much dependability to 7 or 8 years or something like that tend to get in trouble because they either anticipate too much or they miss things. But they rhyme. So what rhymes, what does seem to recur, is the fact that most things in life are cyclical, and the reasons for their cyclicality. And they are mostly, you know, when there's too much money, when there's too little risk aversion, when there's too little fear, too much eagerness, et cetera. And that's how you get excesses to the upside that have to be corrected to the downside.
Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.